Hello and welcome to the Global Market Analysis for June 3rd, 2016, an overview of key markets. My name is Jody Samuels, and we're going to take a look at the S&P, the dollar, oil, and gold for the last 5 trading days in light of non-farm payrolls, and also look at the Elliott wave count so we can see what we are expecting for next week's price action. Please read the disclaimer to yourselves. Thanks. It was another action-filled week in the financial markets, with the S&P 500 sliding another 20 points lower as oil ended up flat at $48.76 despite breaching the $50 once again. The dollar, on the other hand, weakened heavily following an awful jobs report, helping gold to surge $35 an ounce for the week, with the 10-year Treasury yields declining by 15 basis points to 1.71%. This chart shows how well the euro, oil, the S&P, and gold have correlated since January of 2016. This week, gold and the dollar followed their inverse relationship as expected, with the dollar selling off substantially on Friday after non-farm payrolls and gold taking off. Similarly, the S&P 500 price action followed the movement of oil all week long. So remember those relationships. Right now, the relationships are such that the dollar and gold follow an inverse relationship, and we're using the Euro USD as the proxy for the US dollar. And oil and S&P are tracking together. And last week we spoke about the commodity currencies also. I'm not talking about that this week. So we're just talking about these 4 markets. Just a note on U.S. economic data. Investors were treated to a flurry of economic data in the U.S. this week, with the majority of the focus being placed on Friday's non-farm payrolls. For the month of May, the U.S. economy created a dreadful 38,000 jobs compared to expectations of 159,000 jobs, while the unemployment rate dropped to 4.7% from 4.9%. As a result of the weak job numbers, the market has now lowered the possibility of a rate hike in June, with the Fed funds rate showing a probability of only 4%. Yesterday, all eyes were on Mario Draghi as he informed that the ECB will continue to buy 80 billion euros worth of bonds under its massive QE program. Despite the slow recovery, there is still a significant amount of pressure on whether the ECB will be able to deliver upon meeting its 2% inflation target. Bottom line for post-Draghi comments, the euro weakened slightly, right over here, and then range traded for the rest of the day prior to Friday's explosive market price action following the non-farm payrolls release right over here. So we can see how the euro traded sideways for most of the week, awaiting, anticipating these market releases, and then found a new direction. However, looking at the wave count, we will see that it's not a new direction at all. Looking at the wave count, and this is the weekly wave count on the euro, we can draw a box around this trading range that really started 1 year ago, more than a year ago. This goes back to March of 2015, and how we have definitely held this trading range. So looking at this latest bit of price action, all this means is that we are likely going to move higher and retest the upper end of this range, still remaining range bound for the euro. This has just put a temporary halt to this move down that started last week. Moving along to oil. Oil once again failed to close above the psychological $50 level, as crude prices reached a high of $50.10 on Tuesday before selling off to a low of $47.75 on Wednesday. The large drop was led by reports that Iraq will supply 5 million extra barrels to its partners in order to capture more market share. The much-anticipated OPEC meeting in Vienna on Thursday proved to be nothing out of the ordinary, as the cartel failed to agree upon an output ceiling or introduce individual member production quotas. This comes as no surprise, given that Iran is hesitant on capping its production and looking to increase their production to pre-sanction levels. With no agreement, the market sold off to test the weekly lows. Nonetheless, crude oil still managed to end the week flat as oil inventory declined by 1.4 million barrels last week in spite of expectations for a 2.5 million barrel drop. When this news came out, oil traded $1.25 higher to retest this previous high. Bottom line for next week, oil will continue to range trade between $47 and $50, which is also consistent with our wave count. Gold has been on a nasty drought over the last few weeks, and especially this week, as it was range bound for most of the week, but finally saw some strong gains following the weak jobs report on Friday. Given the sell-off in the U.S. dollar, gold managed to see inflows as investors started pouring in money with the expectations of a delayed rate hike. Looking at our gold for the last 5 days, with the Euro-USD plotted against it as an overlay in orange, one can readily see the inverse relationship between gold and the dollar. The euro is perfectly correlated with gold. And finally, the S&P 500 followed oil all week long. Once again, as shown in this chart, after the horrible jobs report, the S&P slid almost 20 points lower to reach 2085 before finishing the week at 2097. From an Elliott wave perspective, the S&P is trading in a choppy downtrend within the downtrend channel. Let's have a look. This is the Elliott wave count for the S&P. It's done on the weekly, so we can see the strong uptrend followed by this choppy downtrend channel that we're following. So we are right now testing the market highs. Provided we stay within this channel, expect the S&P to come back down again and test the lower end of the channel. We will reevaluate, reconsider if the S&P makes a significant breakout above this sideways choppy channel. Thank you very much. This is Jody Samuel signing off for the Global Market Analysis for June 3rd. And if you enjoyed this video, please like and subscribe. See you next week.